Welcome to our webinar covering the latest and upcoming changes to property tax this year. I'm Adam Caplan, and together with my colleague Sam Bacall, we work with a wide range of landlords and property investors to help them understand the tax implications of their investment plans and find them reliefs and allowances that help them make the most of their property income. At FFT in the last few months, we've been working hard on increasing the information we send to clients via email communications and our social media channels, and we have some other exciting projects underway. Today's webinar is a first for us. Please bear with us if there are any technical issues. We are new to this, but hopefully in the coming months, we will be presenting further webinars on topics relevant and useful for our clients. Hopefully at the end of the session, there'll be an opportunity for us to answer some questions. If you do have any questions, please enter them in the Q&A option at the bottom of the screen. Over to you, Sam.
Hi, good afternoon, everyone. Thanks for joining us. Okay, so really, I think for a long time now, holding property as an investor or landlord, it's been very popular. And there are many reasons for this. The reasons have been the low rates of interest on deposit accounts, the exponential growth in house prices, although that has slowed down a little bit now. It's favourable really in comparison to the unpredictability of investing in the stock markets. And also, obviously, you've got your property-based TV shows pushing things along a little bit as well. The huge increase in property investment in this way has led to the government reviewing its approach, and it's looked at this and it's tried to balance the need of regular property purchase against investors and also tax revenues. But despite the challenges, property investment still in many cases offers a stronger, more stable return than other forms of investment. So in today's presentation, we're going to look at quite a few topics as listed on the screen. And to some degree we're trying to cover the basics here, but there'll be some tips in there, and really you'll see as we go along that it requires case-by-case thinking and really consideration of the full set of circumstances. So a lot of the time the outcome is going to be discussed with your accountant, which may be us. So just bear that in mind as we go along. So the first topic we're going to cover today is making tax digital for income tax, or MTD for ITSA, as it's known. And it's not admittedly the most exciting topic, but it is one that's going to come into play now in April 26, and it's worth being aware of, and it's worth considering, whether there's some preparation to do and what the implications of it are. It's a little bit of a running joke in our industry when HMRC introduce something like this, because it tends to result in multiple delays and no one really knows if it's actually going to happen. But we did have making tax digital for VAT that did eventually come in, and so we are expecting this to eventually come into play. So the deal with this is that the system, it mandates organizations to digitally record and report tax information on a quarterly basis, which is very different to what's currently the case, which is annually, and also that it's a requirement that software is being used, which is compliant for HMRC purposes. Again, we know from our side that lots of people are using, basic Excel and paper and gathering it all at the year end. So there will be changes for lots of people. This was, as I said, it was initially supposed to be rolled out in April 24, but it's been postponed. And it's been postponed to April 26. And in April 26, it will come into play for businesses, or rather landlords, whose income are above £50,000. This was initially £10,000, but they've seen some level of sense and it's going to be £50,000. And then it will actually come into play a year after, so from April 27, for anyone with 30,000 or more. So that will bring in a lot more people at that point. It's important to know it's based on income and not profit. So I suppose what needs submitting? So we're going to need to be submitting 4 quarterly submissions. It will be one for each stream of income. In a landlord's case, there'll be one for rental income, and then there'll be a final declaration. And the final declaration will be an annual submission, which will replace current self-assessment. The new obligations they're much more demanding. Again, we're doing something 5 times a year rather than once a year, and so there is going to be some level of planning needed ahead. I suppose the question is why do HMRC want quarterly updates? And to some degree, that's a demonstration that the taxpayer is keeping their records up to date regularly, and it will allow taxpayers to get an estimate of their expected tax as well as time goes on. And I suspect there'll be quite a lot of use for the government of the data as it comes in as well. It will give them a chance to measure things more accurately as things go along. If you don't submit on time, so if you're not getting these quarterly submissions in on time, there's going to be a penalty system, although it's a little bit more lenient than some of the historic penalty systems. So for every late submission, there'll be a 1-point penalty, and then this will penalties will progressively get worse as you get more points. So the first 2 points will incur a penalty, and that will be a £200 fixed penalty. And that's on the annual side, and then on the quarterly side, 4 points will trigger a £200 penalty. Subsequent late submissions will give more penalties, and then I suppose a little bit like a driving license, they'll expire after 2 years if you then consistently comply with submission. How to do it? How to comply? Well, you need HMRC compatible software, and that's something that has digital links to HMRC. Now, there was this whole thing with making tax digital for VAT where bridging software was allowed, but at the moment we're not aware that that's going to be the case. So the assumption is we're going to need some form of accounting software, probably one of the sort of more modern cloud accounting software where there's an API, where there's a connection with HMRC, and it allows the records to be kept digitally. It allows a tax return to be generated and submitted to HMRC, and HMRC can receive all the relevant compliance information. You'll see advertisements around from people like Sage and Xero. They've invested massively in this. They see it as a massive opportunity to increase customers, and probably they were the most disappointed when the delay was announced. Is it a good thing? Again, we're fairly skeptical in our industry. It will lead to more administration for property owners, and inevitably accounting costs, which may be good for us, but not so much for the property owners. Speculatively, it could be HMRC introduces some form of payment on account for businesses and for rental businesses particularly, based on the quarterly information received. That's just speculative, but obviously that would be a big change. I suppose the question is, should you prepare early? Well, there are benefits here. You get better visibility over your portfolio, over how your profits are building over the year, so better financial reporting. You'll also have more tax compliance reminders, so you'll know more what you're expected to be paying on the tax side. And also there'll be time savings when recording transactions, because over time it will be less manual and the software will kind of learn as it goes along, and it means more one click rather than typing things in as you go along. So really, the question is, you need to be thinking about preparation, maybe not today, but maybe within the next year or so. We're already assisting businesses with moving over to be ready for making tax digital and can provide advice on this if needed. So that topic's really something to think about. Moving on to capital gains tax. So capital gains tax is probably the most common tax associated with buying and selling properties, and it applies to the gains you make when an asset's disposed of. It will include the obvious things like selling, but also you need to bear this in mind if you're giving away a property, perhaps to a family member, which could potentially be taxed as at market value, as if you've disposed of it at the market value. If there's a transfer of ownership, so for example, if you might be transferring a property into a company, which is something we're going to cover shortly, there could be swaps with properties of different values, This might happen where someone's looking to downsize and swapping with a friend or family. So that needs thought as well, because there'll be a difference in value. And then also on compensation received. So insurance proceeds in the case of a fire where the property is completely lost or destroyed. If there's an excess, then there may be tax on that. So lots to think about, lots of situations where it may apply. There have been a few changes in capital gains tax over the last year or two. The one that's come in most recently, applying from April 24, is that although the basic rate for basic rate taxpayers has remained at 18% on the gains, the rate has dropped for higher rate payers from 28% to 24%. One of the reasons for that reduction is to try and encourage the sale of second homes, to free up the market and help first-time buyers and second steppers. The other thing that's changed is that there's historically, for a number of years, been a tax-free exemption at around £12,300. Last year, that was reduced to £6,000, and this year it's been reduced to £3,000. So that's dropped quite significantly. It's gone very much in the wrong direction. So with these changes, with both the decrease in the allowance and also the decrease in the higher rates you pay on the gains, landlords will need to be thinking about the timing and the strategy of when they choose to buy and sell their properties. The other thing I think that we like to point out, and I'll point out now, is that we've now got a new Labour government in place, and there's always been a background of rumours of an increase in capital gains rates in line with the income tax rates, which will significantly increase them. And if that's a possibility, who knows if or when that will be, but that will be a very big change in the tax on the sale of property, and a big consideration to just watch out for in case there's rumours. There's been another change in the last year or two, although it's not so new anymore, in capital gains tax reporting, and it's something that not everyone's aware of, particularly those who aren't selling properties regularly. So you have to report the sale of a property within 60 days of completion. This actually began as 30 days, but in a classic example of the government sort of messing around and being wishy-washy and failing to accept sort of real-world circumstance where 30 days isn't really necessarily practical, it got moved to 60 days. I think, in fact, in our experience, the reporting portal that you have to report these on, that has to be set up specifically, takes probably about more than 30 days to set up. So, never going to happen. Failing to file the return results in an automatic penalty of £100. And if the return is delayed more than 3 months, daily penalties begin to accrue, and then a further £300 at both 6 and 9 months. So, it's something that to be aware of. Don't miss it, because you can get penalties building up over time. Underpayments, again, or late payments incur interest. And the interest in the current environment, it's not what it was a year or two ago. A year or two ago, you would have been paying interest at 1%. Now you might be paying HMRC at 6-7%. So it's far more punitive than it was. So it's something not to take as casually as maybe it was a year or two ago. I think the mistake we see time and time again is landlords waiting to report as part of the regular tax return process. And given that we see many of our clients wait until the very last minute on the 31st of January, by that point, the penalties and the interest can build up fairly substantially. Okay, so this is quite a big topic. It's something we get asked about all the time, and that really is the question: should I put my property into a limited company, or should I keep it and own it personally and directly? So the reasons why you might want to put it in a limited company are that you get full relief for mortgage and finance costs. For the last few years, this has changed on the directly owned properties, and there's a 20% cap. There's a 20% tax reduction with those, and again with those held in a limited company, there's no cap now or ever. The timing of profit extraction from the business, which is a standard benefit of a limited company, is helpful in the case of having property in a limited company, because you can choose when you bring the profits out of the business. So let's say you're making £100,000 profit in a year, you don't have to extract that all at once, and therefore you won't be taxed on it all in that tax year. You could spread that out over more than 1 year, and you can carefully choose the timing when you extract it, and therefore you can look to minimize the personal tax payable. You also have the opportunity to have different classes of shares, and that accommodates varying income levels, and especially where there's more than one shareholder, you've got flexibility over who sort of takes out what, and again, when. So that's helpful at times. And generally, you're paying tax on profits at the corporation tax rate rather than you're paying straight away at the income tax rates. So again, opportunity for planning there. Practical benefits also are the limitation of liability, which is obviously a massive benefit of a company. And finally, you can often get cheaper finance via a limited company than on a property held directly. So again, lots of attractive reasons to do it. But as you'll see in the next slide, it's essential to plan in advance and consider each unique set of circumstances. It's very much not one size fits all. So here we go, the sort of drawbacks and the other things to think about rather than just sort of plonking it into a limited company straight away. So actually, the first thing to note is, you know, in certain circumstances, you may end up paying more tax. So for example, a basic rate taxpayer paying on a directly owned property will pay 20% income tax on the rental profits, but someone extracting the same funds from a limited company in the same time frame will be paying 19 to 25% corporation tax, and then a further 8.75% dividend tax, and therefore actually in some circumstances you'd be paying more tax. The other thing that's not very well known is ATED, which is the annual tax on envelope dwellings. Again, we find it gets missed a lot. People aren't aware of it. And this applies to residential properties held in limited companies, which are valued over £500,000. There's a set period of valuation where you have to update the valuation on a property. They're 5 yearly. And if the property is let to a connected party or you stay in it yourself, there are charges at a minimum of £4,400 a year on that. And that will these go way up to £287,500. You know, if you're lucky enough to own a property worth over 20 million. Often in practice, this isn't payable because they're rented out to a third party, and therefore you don't have there's a way around. Well, it's not a way around; it's a factual thing. You don't have to pay the tax, but even so, on properties worth more than £500,000, returns are required. So you know, you'll get penalties on those if you don't complete the annual ATED return. So you know, something to be aware of with residential property. The other thing is, if you're not putting a property in on day one, as in if you're not buying the property into the company directly using the company's name, and you've got an existing property and you're thinking about moving it into a limited company, although you have the benefits we've been through, you'll be paying capital gains tax on the transfer of the property to the company. So if you bought the property at £400,000 and the value on the date of transfer is £500,000, you pay tax on that £100,000 gain. You'll also pay stamp duty as if the company is effectively purchasing the property. So you'll have stamp duty to pay as well. Now, you know, you'll Google around and you'll see that there are circumstances where you can get around these. So for example, if you can show there's a genuine business there, so one of the benchmarks for this is typically that you know, you're spending more than 20 hours per week managing the portfolio, so you know, quite a significant portfolio probably, then you can possibly defer the capital gains tax. And there's also a potential stamp duty exemption where the property is owned by a registered partnership, but this very much needs to be considered and handled carefully. You don't want to join any old scheme to do so. There's currently a well-known scheme run by a company called Property 118. That's been a big scheme over the last few years, and there's a number of companies now under investigation with that scheme, and that could lead to significant unintended tax liabilities and possible mortgage defaults as well. And I suppose that's a key point, the mortgage point. On the topic of mortgages, practically, if you are moving a property into a limited company, you need to think about your mortgage terms or any funding you have on that property, the terms of that. You'll need to let the lender know, because there's very likely a term in the contract that doesn't just allow you to move it into a limited company and effectively change the ownership. Therefore, at the very least, you need to be having a conversation with the finance provider. So as you can see, portfolio incorporation, although potentially attractive, needs to be considered very carefully, and guidance from a professional is essential. The cost of doing it can outweigh the benefits. So, don't listen to a random guy on TikTok. Listen to your accountant, I suppose, unless he's on TikTok. I think the last point I'd like to make, just generally talking about residential or personally held properties in a limited company that we do get asked about, is occasionally people think about putting their own house into a limited company. Now, typically we see this as a sort of big red line, don't do it. And that's because, first of all, you have the ATED considerations, which I've talked about. You have capital gains tax. So you'll suddenly go from it being a property that attracts PPR relief as your principal private residence, and suddenly any gains on it will attract capital gains tax, so you'll lose that benefit. And then you'll also have benefit in kind implications. So if you're living in it, you'll have to pay benefit in kinds for the benefit of the rent that you're effectively getting for free, unless you're paying rent at market value. There can be rare circumstances where it makes sense, where maybe you're funding a big project, and you want to keep the money within a limited company, and therefore you don't want to be subject to personal tax on that money before you pay for it, before you pay for the project, and in certain inheritance tax planning situations as well. But it's rare and it's case by case, and advice is essential. So really don't do it casually. You'll end up with a problem. So the next topic is inheritance tax. Obviously, no one wants their heirs to get big tax liabilities on the assets they inherit, and they don't want them to pay large inheritance tax amounts. So, and this is something that's increasingly more common. Families are increasingly having to pay IHT during what's a challenging period in their lives. And owning a substantial property portfolio usually often means exceeding the available IHT allowances. Dying without the mitigation plans in place means that your estate will be liable to a 40% tax rate on any assets over the 325,000 threshold, and your primary residence can add another 175,000 to that. But in reality, that's not such a large amount where you've got a couple of properties. Commercial properties will qualify potentially for business property relief, and therefore no inheritance tax liability, but it doesn't apply to residential properties, and it doesn't apply to company shares where there are residential properties being held and they're deemed to be investment property companies. So planning ahead is really important. You can look into doing things like transferring properties or company shares to beneficiaries while you're still alive, and it completely mitigates the inheritance tax if this is done 7 years before passing. But taper relief also comes into play as well. So if a donor passes away between 3 and 7 years after making a gift, and the value of all the gifts exceeds the threshold, inheritance tax reduces on a sliding scale, and it reduces by 8% each year from the 3rd year onwards. So eventually by the 7th year, you're not paying inheritance tax. And really, how long you expect someone to live comes into the thought process. Although that's, not very compassionate potentially, it does need thinking about how long is someone expected to live. However, you need to be aware that transferring properties could be subject to capital gains tax if there have been gains, and the beneficiaries will need to pay stamp duty as well on the acquisition, even if it's transferred. And really, you need to be potentially, so if you're looking at a portfolio of properties, it may make sense to transfer some properties, but not others. So those which have had large value increases would incur potentially substantial capital gains, which would not be paid if they were received via inheritance. So they might outweigh the benefits of reducing the IHT, particularly if you're not sure how long someone's going to live for. On the other hand, if there's small gains or no gains expected, and someone's expected to live for a number of years, then it could make a lot of sense. And I think one final point to consider here is you can potentially get insurance against inheritance tax as well, which can be used to reduce the risk. So a few things to think about there, and obviously think about it early. Furnished holiday lettings, I'm not going to spend too long on this. It's a useful relief, but it is one it's on its way out. It's been announced that it's going to be abolished in April 25, so it's only in place for less than another year. And the benefit here is that if properties qualify for this, you can claim capital gains tax relief for traders. You're entitled to plant and machinery capital allowances, and profits count as earnings for pension purposes. It applies to properties in the UK or the EEA, so that includes Iceland, Liechtenstein, and Norway. But there has to be sufficient furniture provided, and the visitors must be entitled to use the furniture. The essential point is that when a property qualifies, it receives tax treatment as if it was a business rather than a single property let. So the property must be commercially let, so effectively you need to intend to make a profit. And if you let the property out of season to cover costs but didn't make a profit, the letting will still be treated as commercial. It must meet all three occupancy conditions, which are the total of long-term lets, i.e. over 31 days, doesn't exceed 155 days. It's available, so there's an availability condition. So the let must be available for at least 210 days per year to qualify. And there's a letting condition, so you have to have let the property for more than 105 days in a year, and that actually excludes any periods longer than 31 days. So again, probably not a major topic for future consideration, but it's still something that comes into play with residential property owners. My final section here is just some useful property reliefs to be aware of for landlords. These are fairly basic, but it's worth being aware of them. So you do get an annual property allowance, which is £1,000, and that's available to individuals who receive property income. And if your allowable expenses are higher than this, you would claim your allowable expenses instead. But it does mean that if your allowable expenses are, say, £300, you get a minimum of £1,000 relief annually. And it's also worth knowing, actually, that if you hold a property jointly, for example, you each get £1,000, which is quite handy as well. In terms of allowable expenses, as long as they're used solely for the purposes of renting out the property, HMRC would say wholly and exclusively, which, if you've ever been unlucky enough to be subject to an HMRC tax investigation, is one of their favourite lines and get-outs. And things have to be wholly and exclusively for the purpose of trade, otherwise they just say no. So if they are used solely, then you can subtract expenses from rental income when calculating taxable rental profit. You have replacement relief, which is where you can claim the cost of a replacement of an item capped at the cost of a modern equivalent, and it must improve the old one. It must be an item exclusively used for the property tenant, and the old item can't be available anymore. And the amount is limited to the cost of an equivalent replacement item. If the replacement item is an improvement or upgrade, then you can't claim replacement relief for the full cost. So typical items we're thinking about here are movable furniture, fittings, appliances, TVs, that sort of thing. And then the final point here is rent a room relief, which allows residential landlords to earn up to a tax-free threshold of £7,500 a year by renting out furnished accommodation in their homes. It's worth noting it's not always the best option, as expenses can't be claimed against the letting. And that means that if the tax savings on expenses outweigh the tax savings on the £7,500 tax-free amount, you may be better off opting out and claiming the expenses. So they were the main topics I wanted to cover today. As I've mentioned already, there's quite a lot of subjectivity and case by case here. So, please feel free to ask questions and be in touch after this if you've got any more complex questions and things that need to be considered very specifically. I'm going to hand back over to Adam to deal with a little bit of a Q&A and cover anything that's been asked as we've gone along. Over to you, Adam.
Thank you very much, Sam. So as Sam mentioned, we've got a few minutes now. If anyone has any questions, please put them in the Q&A at the bottom of the screen. There have been one or two which have come through, which we'll look to address in just a moment. So the question has come through. We're considering moving abroad later in the year and renting out our family home. What tax obligations are there? Well, surprise, surprise, there are tax obligations and tax must be paid. HMRC do have a scheme called the non-resident landlord scheme. So if somebody was to move to Spain, for example, or any country which might be a bit sunnier than we have here, they will and rent out their house. The agent will initially deduct basic rate tax just to make sure that HMRC are going to be paid tax, even though the landlord is now abroad. You can then apply to HMRC for that rent to be paid gross if your UK tax affairs are up to date. But this could, clearly apply to somebody who's leaving the UK but holding on to their property and moving abroad. The point is that tax is payable in the UK, and if you are part of the non-resident landlord scheme, then the letting agent will take care of some of that for you, but the UK tax return will have to be done and tax paid here. Obviously, if somebody then becomes resident elsewhere, they need to consider the tax paid in the UK and what needs to be declared in the new country of residence, most likely informing the new jurisdiction of the UK income and claiming a credit for any UK tax paid. The same person has asked another question. They're clearly looking at leaving the UK, I'm not sure why, and asking what happens if they sell their main residence, and as most of us, most people up and down the country will know, that selling your main residence, generally you will be exempt from the capital gains tax that you would normally pay if you were selling an investment property. So generally that's called private residence relief, and that applies for selling your only or main residence. Over the years been known as principal private residence, but private residence relief. There are some conditions applied to that. So if you have a particularly large garden, I think it's an acre, then potentially you will pay capital gains tax. There could be an element of capital gains tax payable. So there are limits on the size of the house and the size of the garden to be eligible for private residence relief. And another thing with regards to PPR, which came up for me in the last couple of weeks, was this was a client who actually has a home in Manchester and a home in London, and had elected for their home in London to be their PPR, their main residence, and they were now moving out of there and letting that property, and were moving back to Manchester, and wanted to know what effect that might have. So obviously everyone's circumstances are different, but there are what's called periods of deemed occupation. So irrespective of whether a person's living in a property or not, potentially the final 9 months of ownership of the property are still considered as if you were living and residing there. And likewise, if somebody was to leave their home and move into a care home, that period is deemed deemed occupation is extended to 36 months. So even if they've been out of their home and in a care home for 2.5, 3 years, it would still be considered their main residence and qualify for this capital gains relief. Okay, those are the couple of questions which have come through. If anyone does have any more specific questions, then we are more than happy to contact them and speak to them offline. But thank you everyone for joining us today on our first webinar, and hopefully we will see you again soon, where we will be able to present other topics relevant and useful for everyone. Thank you.